Welcome to Business Mastery with Dawn Kennedy, your quick under 45-minute dose of expert insights and strategies to make a positive impact on your business and life. Let's get started. Hello, and welcome to this episode of the Business Mastery Podcast. So today we're going to dive into some financial topics that I don't think we really covered before on the show. We've had accountants and tax strategies and things on here, but what about what your costs are and things related to payment processing? What about funding and financing for your business? So I brought George on, who is an expert in this area and has a business that takes care of all of these things, and he's going to dive in and cover this with us. So thank you, George, so much for being here.
Yeah. Hey, Don, thanks a lot for having me. I really appreciate it.
Can you tell everyone who you are and who you serve?
Sure. Again, my name is George Csahiouni, and I'm the president with Swoop Business Solutions, and we are a small to medium-sized business partner. So we help with things, as you mentioned, like payment processing or financing for small business owners.
So just to get started with payment processing, we've been seeing a lot of trends where businesses are starting to charge 3.5 or 5% whenever they run a payment online or a credit card in store. Can we talk a little bit about what those fees are, what they're for, and whether or not we should be doing that?
Yeah, that's a great question, and that's definitely become more and more mainstream, especially after COVID, with rising costs for small business owners. But essentially, there's really two ways to process payments as a business owner. There's to put them into bucket A and bucket B. Bucket A would be a cost plus program or a interchange plus program. And what interchange is basically the cost of doing business to get access to the credit card processing networks with Visa and MasterCard. And typically you have to go through a payment processing broker, or also known as a independent sales organization. And once you get to an independent sales organization to get access to those Visa and MasterCard networks, there's a cost interchange involved for doing business. So the traditional program and the key program that most business owners operate within for payments is that they pay interchange plus the surcharge that's added by the independent sales organization. And that can vary anywhere from, 5 basis points up to 100 basis points on a cost plus program. So typically speaking, and that's going to be a program where the business owner is absorbing the fees at the end of the month, right? They're taking on the brunt of that cost. So, and that typically will float around the national average for a small to medium-sized business owner is that they'll pay usually anywhere from 2.7, 2.8% to maybe 3 to 3.2% all in on a cost plus program in fees, right, of their processing dollar amount per month.
So this is based on the amount of that transaction. So every single transaction is subject to that fee?
Yeah, so those fees get, and I'm talking about an effective rate, so a bottom line all in, which will include the interchange rate from Visa, MasterCard. It'll include the surcharge, but it'll also include some of those ancillary fees that a lot of business owners consider to be junk fees, right? But it'll be like a statement fee, a count on file fee, a batch out fee, anything in addition. So when I say 2.7 to 3.2%, I'm saying all in, right? So yes, that's correct. When we're talking about a $100 transaction, at an all-in, call it average 3% effective rate, that merchant's going to pay 3% or $3 on that $100 transaction. They're going to absorb that fee at the end of the day. So that's the traditional way of doing it. Now, what you had mentioned is maybe passing on fees at anywhere from 3% to 3.5%, or up to the legal limit, which is currently 3.95%. And there's some a legal fight going on with that currently in the marketplace. But what that option is to do really where the business owner can pass the fees on to their end consumer, to their client, right? So interchange still applies. The surcharge from the independent sales organization and all those other ancillary fees would still apply. The only difference is that the business owner, instead of absorbing the fees and taking, one large sum at the end of the month that they have to pay as a business owner, they're breaking it up into small pieces on each individual transaction, and they're passing that on to their customer. So, for example, if John at John's bicycle shop sells a bicycle for $100, that 3% fee would get moved for a credit or debit card transaction to that buyer of that bicycle, so that the person buying the bike would actually pay $103 should they use a credit or debit card. And the opposite, or the in benefit to the business owner and to the customer on that type of a program, is if they paid with cash, they would get a 3% or up to a 4% cash discount. And you'll hear that word a lot in the industry, to pay with cash, which, as we all know, not many folks are carrying a lot of cash these days, but that is the option.
Right. So bottom line to the business is under bucket A traditional, they end up with only $97. Bucket B, they get the whole 100.
Correct. They get the whole 100, correct. But in bucket B, the merchant or the consumer pays, you know, call it 3% or whatever that rate's set at, more than what they would typically pay by using a debit or credit card. That's correct.
So from where you're sitting, are you seeing, because like you're saying, it's becoming more mainstream that if you're going to transact business with a small business, they are going to give you, that percentage to run your card. Are you seeing this, even though it's more mainstream, are you seeing this maybe discourage people from doing online or, payment fees at the terminal?
Yeah, that's a great question. So I think it really depends on the product and the service that's being sold. So it's actually very interesting because there's not much pushback in some industries, if any pushback at all. But depending on, and what I would say is the key indicator is the average ticket or the average sales price of the product or service being sold. And I'll give you a couple of examples. If you're a quick service restaurant or a fast casual restaurant, and you have an average sale price of, call it, for an order of $20 at a 3% fee or add-on surcharge, where the business owner of that quick service restaurant is passing it on to the customer, that's only 60 cents in addition to the customer, to the buyer of that food order, right? So the total $20 transaction goes to $20.60. So because it's not a very large increase, there's very minimal, if any, in that type of a scenario, as far as pushback from the consumer. Now, however, if you're selling, for example, a garage door, right? And I'm a garage door sales company, and my average order is maybe $2,500 at 3%. Now you're talking approximately $100 increase on that surcharge, right? So it really depends on the industry and the product type.
But how much on average? I know it's only 3%, but I mean, it really has been going up the number of transactions by card and stuff. I mean, businesses who don't pass this on could end up losing quite a bit. You were finishing up your garage door example. It's $100.
Yeah, so if it's a garage door sales company, and for example, their average sales price is $2,500, right? At a 3% surcharge, that's going to be an additional $100 to the end consumer who's going to purchase that garage door. So when that surcharge, has a significant dollar amount attached to it because the average sales price of the product is much larger, that's when you're going to start to get some kickback and pushback from the consumer. So, just as a general rule of thumb, if you're a business owner that's thinking about, adding a surcharge to offset those fees, which I think is viable. And I think that if you're a small to medium sized business owner, it's absolutely something that you should consider because it is more mainstream. But the general rule of thumb is the lower the average ticket or your average sale is, the less pushback that you're going to get from consumers, just because it only adds, sometimes an insignificant dollar amount, or a minimally noticeable dollar amount, I should say.
Right. And, for listeners out there and just small businesses in general, if they're not passing on this fee, I mean, it can sometimes feel a little hidden if you're working with a processor that'll remove the fees each day they batch. But I mean, ultimately, at the end of the month, we could be looking at hundreds of dollars in processing fees that could have actually gone to working capital.
100%. What I would say there, with regards to the benefit of the business owner, what's a good processing program, or, just what's a good rate? right? So if we're talking about that traditional bucket A, a cost plus or interchange plus program where you, the business owner, want to absorb the fees, a strong rate in today's market is going to be somewhere between like 2.2 to 2.5% all in. That's a pretty good, strong rate for a small to medium sized business owner. So, if you're looking, and that typically what that means for anybody, who digs into their merchant statements on a more granular level, that typically means, interchange, which floats around on credit cards. That's going to float depending on fraud and what's going on in the marketplace. It can vary, and also by card type. So, like rewards cards or corporate cards, things of that nature. But on average, interchange in the current marketplace is going to be about 1.8 to 1.9%. So that's going to be the cost to access the networks from Visa and MasterCard. And if you can get to a rate at 2.2 to 2.5%, what that means is that the broker or the payment processing company that you're going with is only charging somewhere between, a quarter percent or 25 basis points up to about 50, a half a percent or 50 basis points, if that makes sense, over the cost of Visa, MasterCard. So that would be a strong rate, just as, if you're out there shopping in the marketplace currently.
So here's an interesting statement that you made that if somebody's using, let's say, a rewards card or a fleet card, I've seen it with fleet cards particularly, and some other types of cards, that rate actually goes up. As the merchant, we don't know how much it's actually going to maybe cost us. Is that true?
Well, it's on the agreement. It should definitely be listed on the merchant processing agreement that's executed between the payment processing company and the merchant or the business owner. That being said, it's not always easy to decipher. And to be frank and transparent, these payment processing companies know that, right? They're not always, they make it a little hazy, I should say, because obviously that's where they earn their revenue is per transaction. That being said, it absolutely should be listed on the merchant processing application. But, just I could jam through a couple of items. Fleet cards typically, so if you're doing like a Voyager or a Flex or a Right type of a fleet card, those are typically going to be around 3.5% all in. And, corporate cards or rewards cards, things that have rewards attached to them, like frequent flyer miles, cash back, money savings, someone has to pay for those rewards. So, in the current marketplace and kind of how it's currently designed to process payments, that typically and unfortunately gets pushed down to the business owner. So they're gonna see that increased cost if they're taking those types of cards. Now, a suggestion would be if you are like, for example, a sit down fine dining restaurant and that you get lots of corporate business or you're doing lots of maybe events or things of that nature, and you're going to take a lot of corporate cards, right? Then you should absolutely bring that up in the negotiation with the payment processing company and have them spell it out for you. And it's absolutely defined. And if you do that up front, typically the merchant can get educated and also reduce their costs early on, which is when it needs to happen.
Right. Yeah, this is a good conversation because I don't know if in the aggregate, most of us know at the end of the month what we've totally paid in processing fees. And to be honest, cards are a convenience for the customer because, as you said, people don't carry a lot of cash. So, really, to absorb that quote unquote cost of doing business can actually, really rob us of some profits and possibly some cash flow.
Totally. Totally. Yeah, I mean, and that's where the, the call it the invention or the creation of passing the fees on to the customer came about. If you look at the current marketplace, we're talking about COGS and cost of goods sold rising because of inflation and things of that nature, and the difficulty of getting good employees at a reasonable wage that are also effective, plus rising costs of payment processing, in addition to rising cost of rent, right? So if you're a small business owner, they're getting squeezed as many of us know from, those key angles and sometimes much more. So, and now it's starting to get trickled down to the consumer, hence the fees being passed on to them in many cases.
Right, right. So again, kind of that good rule of thumb if you're listening in is look at your average ticket and see whether or not this would be, beneficial to at least look and see what you could do in your own business. And as you said, the higher the ticket, the harder it would really be to shift that over to the buyer.
Correct. Correct. And one other suggestion I would just say is that, just a good best practice if you're a business owner is, every 3 months or every 6 months, shop your current provider. It doesn't necessarily mean that you have to switch payment processors. But, one thing that most payment processors will do is if you get a written quote, something in writing, whether it be via email, on paper, digital, and then send that into your current payment processor every 3 to 6 months, it's very likely that they will at least meet or beat or have to educate you further on what your current rate program is. So then they can optimize it for you, which is, what we suggest to all of our clients that we work with.
Yeah, that's a great point. I'm not sure how many people listening in have really ever shopped around. It almost is like a set and forget, right? So you get your processor set up, get your merchant account set up, and then you don't think about it again, you know,
Sure.
for a number of years, if at all, or maybe until you listen to this podcast. So let's shift over to talking about the other thing you do a lot of, and that is business finance. In the new, I guess, economy or the economic conditions right now, financing from the SBA due to the idle loans and stuff, has been reduced, and they're not actually doing as many loans. So areas of business financing, let's say for expansion or something, not necessarily startup, but once you're actually up and running and you need working capital and things, what are you seeing in the marketplace now? Because certain avenues that used to be more readily available feel like they're closing off.
Yeah. Well, with rates rising across the board and, it's the number one thing that we're seeing with business owners is that, they're not able to either get access to capital, access to enough capital, or access to capital in a timely fashion that's effective for their needs and challenges that they're facing. Right. So kind of what we do, with our organization is that we do some creative financing that is specific to small to medium sized business owners that really kind of cover a few key areas, right? And typically, where an SBA may take, 60, 90, or 120 days, and in the current market may even be difficult or not even available here in the near future. We give them access to capital for things like software, hardware, or equipment financing. And we also give them access to capital for, as you mentioned, for things like payroll or inventory. And that could be on a reoccurring basis, right? So, kind of like a line of credit, which we also do, but where they can draw against that capital as needed. And then lastly, we also give them access to capital for, you know, small to medium sized business term loans that are very quick turnarounds and usually anywhere from like 2 years to 7 years, anywhere from, $25,000 up to $5 million. But those types of term loans are built for small business owners. So we take a look at things that are different than your retail kind of bank than like a Bank of America, a US Bank, a JP Morgan Chase, those types of banks, they're looking on a much larger, wider scale. But working with an organization like us or other companies like us that are out there in the marketplace, we can move a lot more quickly through just knowing the market and also being a lot more agile in the underwriting process.
Right. Let's talk about some of the benefits of some of the different financial products you were talking about. So, things like you were saying for software, hardware, and that kind of equipment, that would be probably term, it would have a set payment, it would have the equipment as collateral. Something like that, is that a little bit easier maybe to get than something like for working capital or payroll?
100%. 100%.
Well, yeah, let's break this down a little so people can understand not just the differences, but like what they would need to show to kind of qualify for these things.
Sure. So if you're an operating business, typically that's retail, brick and mortar, and you have been in business typically for And we have programs that are both for brand new businesses that are doing a brand new build out and or existing businesses. But if you've been in business for 6 months or longer and you have some cash flow that's flowing in your business, we offer terms anywhere from 12, 24, 36, 48, or even 60 months to be able to get software, hardware, or equipment. And what I mean by software, it could be that, you have a operating software that you need to purchase to help manage your business in some capacity, such as a payroll or HR software, or just the overall SaaS, right? Software as a service that maybe is just an operating system or a CRM type of a system that has large upfront cost. So we could help finance that for you. Or maybe there's like integration to that cost. So API or some programming that's needed. So, with business owners, especially when they're getting launched and or if they need to upgrade, right? You have technology, it's older, that needs upgrading, and you don't have the financial wherewithal to do a big cash outlay, whether it be software or hardware, right? So that could be hardware such as copy machines, point of sale technology, menu boards, or equipment, right? When we get into equipment, that could be things like automotive lifts, um, signage, coolers and grills or ice machines. So if you're a business owner, that you want to be able to finance things that depreciate, and you want to buy things, right, that appreciate, right? So a lot of times when we're talking about technology, software, and hardware, number one, you want to be able to replace it 2, 3, 4, 5, 6, 7, 8 years down the road because from the wear and tear, it's going to need some upgrading. So, these types of programs are one, give the business owner to do that. They're flexible terms. It's a fast turnaround. So on something like this, it would be like as simple as a 2-page application, an ID, and basic business information, name, address, phone number, tax ID, owner information, that type of stuff. The turnaround for the approvals within 24 hours, typically speaking, and they could have financing on a product like that within days, right? Whereas going to a bank, that process may take 30, 60, 90 days or longer. And they typically don't have specialized program for business owners on equipment. The other thing that's a benefit for the business owners when they go that route, when they look at a specific technology or equipment finance agreement, what's really awesome is that they can actually expense or write off the monthly payment on their taxes. So not only do they get the value of the product, and they can upgrade probably down the road when that term is up if they need to replace that equipment, or they can own it and keep it. But they also get to write off that monthly payment on an annual basis, and they get 100% benefit from that by expensing that payment. So for a business owner, if you're looking to add technology that's maybe 10, 20, 30, 40, $50,000 or equipment or more, from our perspective, this is really the only way to go in today's market.
Yeah, it keeps your cash inside the business where it may be needed for other things that are not necessarily, like you said, depreciating. So,
Like adding sales or, revenue or adding employees, all that good stuff that is, the stuff that helps, bring in new traffic to the business.
right, right. And for all of this, again, you would do a cost benefit analysis in your business and look at, how this is going to help you short term and then long term. So let's talk about a line of credit and this revolving credit and what's different about this in a business and how it can also be beneficial.
Sure. So, you have your equipment financing, your technology financing. That's a bucket. Another bucket is a line of credit. And a line of credit is fantastic for business owners that kind of want to have that extra support. Maybe they're financially stable, or, they know that they're going to run into some bumps in the road and or there's holes in their budget. And a line of credit is really great because you're going to get a strong rate. It's going to draw against it'll be a personal guarantee. So either on the business credit, and that'll use the tax ID if it's a corporate only application, which you can do, or a personal guarantee, or both, right? But what it is it's unsecured financing that's going to give you a strong rate. Those rates are typically What we're seeing currently in the marketplace is anywhere from like 5% up to 15%. Many lines of credit float around 9 to 13%, right in that range. So very competitive. And what's nice about it is you only pay interest on what you draw out on that line of credit. So it's basically like a large credit card where a business owner can actually pull out cash or directly pay from that line of credit vendors or purchases as needed. And that works really well for folks that, maybe don't have access to things like a net 30 or a net 60 on inventory purchases, or again, have holes in their budget, or they're looking to do a marketing blitz or add, two or three employees and expand the size of their team. And they need some float money until they kind of ramp up. So a line of credit's really good anytime that you're going to need to draw some extra funds, but then you're going to get a return on that in the near future is how we would recommend using that type of scenario. But again, the line of credit could be used for many, many things, but that's how most business owners typically use it for full advantage and maximizing the cost.
You said it was a really like big credit card, but let's be honest. You're saying 5 to 15%. A lot of corporate cards and just credit cards in general are going up. And those interest rates can reset really with like 30 to 60 days written notice. Once you get a line of credit at a particular interest rate, does it reset?
That's a great question. I'm glad you asked that. So, a line of credit's going to have a term with it, right? So it'll say, you can do a 2-year line of credit, 3-year, 5-year, or 10-year, and it depends on what type of structure that business owner really needs. But basically, what we're saying there is that rate's going to be locked for all of the draws that you would pull out on that line of credit for that period of time. So, what's very standard line of credit might be a 3-year line of credit for a business owner, and at that point, they can reapply or reset or extend at whatever market rate is. And typically speaking, unless there's a huge fluctuation in the market, which we actually have seen here and there, but typically speaking, when you build that history with that line of credit as a business owner, the rates don't typically go down. As long as you're paying on time and you're drawing money and repaying that money back, you're typically going to have the same rate or better when that term is up, right? Should you try to renew or amplify that line of credit. But it does, to your point, it does lock in that rate for a period of time. And what's nice about a line of credit is you can keep using it over and over again. So, for example, like a credit card, however, the rates are much lower, which you pointed out, typically speaking. If I'm buying inventory and I want to buy $30,000 worth of inventory in a line of credit, sell that inventory for profit, pay off that line of credit, and keep doing that over and over and over again. That's really the power of a line of credit that allows you to maximize that leverage.
Right. And if you don't use it, to your point, you wouldn't pay anything. Whereas if you had a term loan, those payments are always due, whether or not you sold something or if somebody hasn't paid their invoice.
Yeah, that's correct. So then and that's nice too, because you only pay on what you draw out on the line of credit. So for example, if you have $100,000 approved line of credit and you take out $25,000 and your rate's 10%, you're only going to pay 10% on that $25,000 as you make those payments. And not the other $75,000 is still available to you for whenever you want to use it, and you don't pay interest unless you pull the money out. So a lot of flexibility there with a line of credit. It's great for emergencies and great for some of the other items that I mentioned already.
Right. And I think one of the most important reasons we're doing this episode now is because of the changing landscape inside the economy, inside consumer buying behavior. People are taking a much longer runway to make larger purchases. And, sometimes that cost of carrying inventory and things really can eat away, not just at your profit margin, but your cash flow. And
Sure.
we don't talk about this stuff a whole lot on here, but I think educating business owners about some alternatives, because a lot of us had bootstrapped our way starting, or they got an SBA loan set up, paid it off, and then they're just running. But I think, the idea that we have to be looking for other opportunities as needed to stay open, particularly over the next, I would say 18 to 24 months is when the Wall Street people who are much smarter than I am say interest rates may start coming back down.
Sure.
What do we to bridge that gap?
Yeah, what I like to add there too is, when I think about some of this financing for small to medium sized businesses and to bridge the gap, as you mentioned, but also coming out of COVID and previous economic, difficulties for many of these owners, there's definitely still a hangover in the marketplace that we're all kind of still navigating and figuring out new innovative ways to manage these small businesses and to get financing and things of that nature. And the reason why I want to bring that up is because if you're a business owner also that had some financial hardship, as many, many did. And maybe you have some rough spots in your credit or, some blemishes there. And you're a little concerned, can I get financing, whether it be from a retail bank or an SBA or some of the creative options that we're talking about that are specific to businesses? And I want to just point out that this financing option is built for business owners. So, when you're looking at like equipment financing, as well as one other type of financing that I haven't mentioned, which is a merchant cash advance. Those types of financing options, look at revenue. They look at how much you're processing in your credit card transactions. They're looking at your bank deposits. So subprime to excellent credit is okay. There is a program for all business owners there. So if you're wondering how can I get cash right away to do some of these things, these programs are built for you. And like if you're a merchant right now or a business owner that needs money quickly, so you have your technology and your equipment financing, you have your line of credit as kind of backup or for maybe rolling available cash to be able to purchase things like inventory or payroll or whatnot. But if you needed money right away, fast and quick within 5 to 10 business days, while the money is not the most inexpensive, it's also not super expensive. But while the money's not the most inexpensive, if you have no other option, you need something to strike on an opportunity, maybe to expand, or there was an act of God, and maybe, God forbid, there was a tree that fell on the roof of your business, or, who knows, right? A merchant cash advance might be the way to go because the way that that is collateralized is through the deposits, through the cash flow that are incoming into the business. Again, they're going to look at payment processing statements, bank deposits. But what's nice about that is that it's a quick turnaround, right? So if you're in need of money quickly, as often happens for business owners, because there's always an unexpected challenge, a fire to put out, that's also a really good option, in my opinion, in those scenarios.
Yeah, that's great. I mean, this is really helpful discussion in letting people think through and prioritize maybe um if I've been thinking about doing a particular thing, maybe expanding, and I don't know because it feels overwhelming. There's all these parts and pieces. It sounds like, this is something that you can start to think about. Where would I need to get capital from first? And then again, that cost benefit analysis. What's the fastest and most painless return on whatever investment I'm making from money that I've borrowed to expand?
Yeah.
So, George, where can people find you and learn more about Swoop?
Sure. So you can find us easily at on our website, which is just www.swoopbusinesssolutions.com. And Swoop is SWOOP, businesssolutions.com. You can shoot us an email at info@swooppay, SWOOPPAY.com, or you can just give us a call. We love to chat. We have some very experienced team members that love to work with business owners daily and kind of break down some of that cost benefit analysis. So feel free to just give us a call. We'd love to chat with you. That's 877-707-9667. 877-707-9667.
Great. So we're going to put all of this down inside the show notes and we're going to link to the website. So if you're listening to this the day we launch, if you're listening 2 years later, you can still find George and Swoop and get your financing questions answered and maybe even look at what you're paying in merchant fees. Because I think that that's sometimes an out in the open yet hidden expense that either you thought you would absorb and maybe be part of cost of doing business, but as you pointed out eloquently, inflation and things are making margins thinner and thinner.
Sure. Well, hey, Don, thanks so much for having me. I'm very, very excited to spend some time with you and with your audience.
Yeah, we love having you, and I appreciate this conversation so much. So thank you for joining me. All right, we'll talk to y'all next time on the next episode of the Business Mastery Podcast. Take care. Thank you so much for listening to this episode of the Business Mastery Podcast. If you want to learn more about me, you can go to DawnKKennedy.com, and you can now check us out on YouTube, as well as, of course, any of your favorite platforms that host podcasts. Take care.